Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Bobby Rains here for our once every 3 weeks Investors Observer Members Only workshop. Let's get into our agenda here. We're going to start out with a market update. We'll talk about what's going on at Investors Observer. And then member-driven content, questions, site demonstrations, etc. We got a question from Dick ahead of time. I have a couple of slides queued up for that, but if you have questions, additional questions, put them in the box. I can either get to them while I'm talking, as this subject suggests, or we'll get to them at the end. So with that, let's get into our market update. Yes, also, as you will see, when we get to the end of the slides, we have some slides based on Dick's question. I'm more than happy to put together slides submitted ahead of time. Just mention you think it would be a thing you'd like to hear talked about in the workshop. And we did also answer Rick's question when he asked it, so you don't have to just send in a question and wait. All right, so this is a fun chart. This is 20 years worth of candles on the S&P 500. It's interesting because we noticed that the highs last year sort of lined up with the bottom of this trend line from the dot-com boom up until the housing collapse, which is interesting in any case. And we stayed well in this channel even in December. But yeah, getting back to new highs now gives us a little bit more room outside that channel, but it is sort of an interesting long-term thing to keep an eye on. All right, now this is the last 2 years of one-day candles. You can see a version of this chart with a lot more support and resistance lines in our Friday blog post. I would imagine we'll have some updated version of this on Friday of this week. If not, you can always, even right now, go look at last Friday's. 2,800 is the big number right now. It is both a round number and a number at which there are a number of old highs or other inflection points that form resistance. It was a battle back here that we ultimately lost in the fall, and then we hit it earlier this week and went right back down. So that's kind of interesting and sort of the number that everybody's keeping their eye on in any case. And then here are some charts I put together of the Dow versus the Russell. This is for 2017. The Dow won 2017 if it were to be a race. And that's because the story of 2017 from a market's perspective was about taxes, right? So the big companies that are in the Dow are better able to move their resources around and do things that take advantage of changes in tax law, shifting money around, bringing money back onshore from offshore, taking things like immediate depreciation on capital expenditures. All that stuff helps bigger companies more than helps smaller companies, and so the big companies won. 2018, though, was about trade by and large. I cut this chart off at the end of August. One, because that's what made my point most dramatically, but also because I think there's a good case to be made that starting in September was when we started to hear a lot of talk about the recession that was right around the corner that led to us having a pretty miserable fourth quarter of the year last year in the stock market. So the story stopped being about trade at the end of August. But you can see the smaller companies outperformed. The Russell outperformed in 2018 because smaller companies are less exposed to trade than larger companies, right? Like your Caterpillars, your Boeings, those guys are selling stuff all over the world. And if there's going to be a trade war or tariffs, they're going to get hit a lot harder than smaller companies who are primarily onshore. So that's where that is. And yeah, like the Russell got absolutely pounded in the fourth quarter, because once you start talking about recession, the smaller companies are typically less good at weathering a recession than the larger companies, just because they're smaller and they have less cushion. All right, so what else is going on? Earnings season's pretty much over at this point. There's still some retailers and some other people reporting. It was fine. There's nothing really to get excited or upset about. Some earnings were good, some earnings were bad. Generally, I think the guidance wasn't quite as high as maybe people expected. Still calling for growth. Generally, though, most things are. It's not as high. Yeah, it's relatively slow growth, but that counts as growth still. So we'll see how things work out. The quarter ends at the end of this month, and so towards the middle of April, we'll start getting earnings reports, and we'll see what's going on. Trade is back to being the big story. I think if you read the morning update, pretty much every day this week and maybe every day last week, it's been a China headline. Has been what's moving the market in the pre-markets, and that's how that works. Again, we're at a point where there have been multiple rounds of talks at this point, but we don't really know what's in the deal that we're supposed to be getting closer to. Maybe China's going to buy some more stuff. It seems like is going to be part of that deal, but how much and what is it? Nobody seems to know. There's a bunch of reports out. I mean, I think it's pretty well known that the president governs, or at least measures his governing, at least in part, on the stock market. He loves to talk about it when the market is up. So there are some reports out today that he's very worried about the market and how the trade deal is going to affect the market, which suggests that that might be a positive for stocks. If you have somebody who's worried about stocks and they have some power to do something, it's probably good for stocks. The problem we have is that what the market wants probably isn't the same things as the structural changes that Trump says he's pushing for. And so again, you sort of come down to the free traders versus the China hawks in terms of, are we really going to hold out for a deal with strong intellectual property protections and things like that and some enforcement mechanism? Or are we going to try to get a deal so we can get rid of some tariffs and the stock market will go back up? I don't actually know the answer to that. I have some guesses based on who's in charge and what they seem to worry about, but we'll see how it shakes out. NAFTA was the new NAFTA, the USMCA or whatever it's called, is not significantly different from the previous NAFTA. We sell slightly more milk to Canada now, and there's some slightly higher wages called for down the road in terms of auto parts manufacturing, but it's basically the same thing. So for stocks coming out of it, getting a China deal that's basically the pre-tariff status quo, probably good for stocks. Not good for the China hawks, maybe bad long term because we don't get the structural changes we're looking for. But in terms of what the stock market wants, it's probably something similar to that. We seem to be past shutdowns for a while. There is a debt ceiling deadline in early June. We're into the extraordinary measures part of the debt ceiling dance. So we'll see how that goes. Hopefully nobody's going to be real dumb and make that an issue, but we'll see how that plays out. The Fed has been a driver for a long time. The Fed's really trying to get out of moving the stock market, it seems like. Interest rates I meant to say aggressively patient, but aggressively positive is another way to look at it in terms of how the market views it. There's continued slack in the labor market. Janet Yellen said some things back when she was the Fed chair about being sort of surprised by where inflation was, given how long unemployment had been low. And what you see is, yes, the unemployment rate has been low for a long time, but the labor force participation rate has been slowly rising. So people are going from not in the workforce to employed, which means they don't show up in the unemployment rate until they have a job. And so that, I think, sort of explains the missing inflation, and also explains the relatively low pace of wage gains. There is still some slack out there. And the Fed seems to be on the path now of, instead of looking at things that previously correlated and trying to make decisions based on those, for years and years, low unemployment always led to inflation. It doesn't this time. So I think the Fed is kind of trying to take a step back and say, well, I guess if we're trying to keep inflation in check, what we should do is look at the rate of inflation and then make decisions based on that, as opposed to looking at things that we think might predict the rate of inflation when that relationship seems to be broken. And then politics in Europe is what it is. There's some parliamentary elections for the EU, I think, later this year that could be interesting. In the short term, though, it's all Brexit all the time, and I don't think anybody has any idea how that's going to play out. Markets generally don't care for brinksmanship a whole lot, so there could be some sort of, if we get some sort of resolution, you could get a rally. I think if you get a no-deal Brexit, it's going to be pretty ugly in Europe, which will probably have some spillover effects, but it's kind of hard to guess what those would be as of now. All right, so that's the market wrap up. The next bullet point, if you think back to my agenda, was what's going on in Investors Observer. I don't have a ton to tell you in terms of new developments. We're working on some stuff that we're pretty excited about. We don't have a plan to release it yet, but you will be hearing about it as soon as we get ready. And we think it's going to be pretty exciting. All right, so let's get into the Q&A portion. So like I said, this was a question from Dick, who asked about using the options market to predict earnings moves. So the options market can predict, in effect, the magnitude, but not the direction of a post-earnings move. So you can say up or down by a percentage is essentially how that's going to work. There are ways to trade that. The best way to trade it is to probably look at what you think what the market thinks, and then look at what you think, and if they're different, then you can bet on that. Or if you have a strong directional bias, you could take advantage of it that way. So the reason this works is options are generally priced according to a model which includes distance to the strike price, time to expiration, historical volatility, and interest rates. And so if you think about those four things, three of them are relatively constant and unlikely to change. The distance to the strike price will change as the stock price changes, but you know exactly what that number is just by looking at it. Time to expiration, same thing, right? It changes over time, but at a pretty constant rate. Interest rates, not moving a whole lot, fine. Historical volatility, though, is making a big assumption. You're making an assumption that the future looks like the past, which sometimes is true, but sometimes isn't true. And so, if you think of an option price as being the output of an equation that takes those four things into account, and then the market starts to move prices around after that, variations in the option price away from the model price means that you can sort of solve the equation backwards for the volatility variable, and you get a different number than historical volatility. And it is implied volatility, right? It's exactly what it sounds like, right? Like, all these other things being equal, what the price here implies is a volatility, a number of volatility. Implied volatility is not actually a Greek, but it's related to the Greeks. They're usually grouped in together. And it's typically higher anytime volatility can be predicted. So ahead of earnings, FDA announcements for your drug manufacturers and biotech companies, other things like that. Sometimes it's higher and you don't know why. But a lot of times, especially ahead of earnings, other big events that you can predict and anticipate. The prices on options will be higher because volatility is expected. So how do you actually use options to predict earnings moves? Basically, you calculate the price for a long straddle, which is buying an at-the-money call and buying an at-the-money put. So divide the price of that straddle by the stock price, and that will give you the percentage, the percentage that the market is expecting to move by that expiration date. So it's pretty easy. Stocks that have weekly options, you just find the nearest Friday after the earnings date. And you can do that with the monthlies. Like if a company reports in the first week, and you got an extra 2 weeks in there, it's not quite as clean a calculation in terms of the prediction, but it's pretty handy. So let's look at an example here. All right, so Kroger reports. I forget exactly what day Kroger reports this week. They report one day this week, and I looked these prices up right before the close yesterday. So Kroger was at $28.90. The March 8th, which is this Friday, 29 call was 99 cents to buy. The 29 put was $1.10 to buy. So that means that the long straddle is 209. So 209 is 7.23% of the 28.90 that is Kroger's stock price. So that is roughly how far the market thinks that Kroger might move in one direction or the other after earnings. So if you think about this, what it means is if you bought this straddle, right? You bought the put and you bought the call. If Kroger moves more than 7, let's call that 7.25 just to make it easy. If Kroger moves more than 7.25% in either direction between now and Friday, you make money on your straddle. If it stays in between, you're going to lose money when the options expire. But that's how that works. And so, essentially the market is predicting break even, right? It's a bookmaker, right? Trying to get equal money on both sides of the trade. And so you try to pick a thing that's kind of in the middle. So just to show you how much implied volatility is in those options, I went out to the next week and calculated the same thing. So the long straddle for next week's expiration, the 15th, costs $224, which if you think about that, that's sort of bananas. It's almost backwards from how you would normally expect it to be. Normally, most of the time value would be in, with 2 weeks left, most of the time value would be in the out week. But in this case, most of the time value is in the front week. There's, it suggests 15 cents there. When we get to Monday of next week, I don't think that option will be trading at, or that straddle will be trading at 15 cents. But the prices options will go way down, and then some things will normalize. And that dive in option prices is referred to as a volatility crush or an implied volatility crush. And it's because the thing that people were uncertain about is in the past now, so they're not uncertain about it anymore. And so the implied volatility will sort of revert back to the historical volatility. And that is how that works. So, yeah, that's that in terms of questions from the audience. It looks like we have a follow-up here from Sonia who says, can the direction be deducted by the higher of the call or put? Not really. In this case, the put price is a little bit higher because the put is a little bit in the money, so it has 10 cents of intrinsic value, which basically covers the whole difference. You could probably try to solve for implied volatility at a bunch of near the money strikes and look and see which was higher and get some idea of what the market thought might happen from there. But that gets to be a pretty messy exercise, and one or two, in a lot of cases, one or two stocks could really move that around or one or two trades could really move that around in ways that may just reveal one or two traders' biases and not any sort of greater wisdom of the crowd sort of thing. All right, Rick has a question about the picture next to Brexit, which I think he means, hang on, let me bring my slides back up here. This guy. That is what is known as a shruggy. Yeah, I don't know. It just means shrug. All right, and then Jeff has a question about MCK, which is trade in the portfolios. Let's go here and look at that. Yeah, so McKesson has gone down quite a bit since we put this trade out. All of the healthcare sector has gone down a decent amount since we put this trade out. And the reason given seems to be people are worried about Medicare for all, which certainly would probably suck some profits out of the healthcare industry. It seems like an awfully big move for something that, to my mind, seems like a tail risk. Yeah, it's certainly not happening in the next 2 years. And after that, seems like it would be quite a fight. So, yeah, I don't know. The move there doesn't make a ton of sense to me. We're keeping an eye on it, and we've been looking at, possibly rolling the call or trying to do something. I'd kind of prefer not to dump it because I don't necessarily believe in the bear case right now. But that is what's going on there. Is people are worried about Medicare for all, and so they're selling healthcare stocks. I mean, you can look at here. Let me pull this up. You can look at. Go to a better chart. Yeah, so you can look at the last week or so on UNH, and it's also been pounded, and so has Anthem, CVS. Yeah, they're all just getting beaten into the dirt because apparently people are worried about Medicare for all. Again, like I said, it seems like a weird tail risk to me, and I'm not sure why the market has this belief, but I don't get to tell the market it's wrong. I just have to put up with it. All right, more questions. Rick, that's the thing that we pay for. Sorry, Rick had a question about QuoteStream, which is the thing I just pulled up for the chart. It's a thing that we pay for. Is where I get a lot of data. Our analysts have that on their desks most of the time. Sort of keep abreast of the market. It's got charts and option prices and all kinds of stuff in real time. So yeah, it's a thing we paid for. The company behind this is called Quote Media, but I think you can probably find it at quotestream.com, if I remember correctly. All right, so Ron says, in the morning action, typically have covered calls at the money or in the money, and what is the rationale? I mean, at the money is where the option premium is, Ron. And so that's where we try to put things. They're usually either a little bit or a little bit out or a little bit in because there's no hard and fast. There very rarely is an exactly at the money strike. But yeah, that's where the highest option premium is. So if you're, relatively agnostic about keeping the stock and you're trying to make money in covered call writing, writing covered calls where the premium is highest is the strategy to use, and so we write them at the money. For things that you had some sentimental or other attachment to, we have a tool in the trade idea generator that'll help you find an out of the money covered call that usually has it's usually somewhere around a 30 delta or so it has a much less chance of being called away. You go to the stock page and then hit out of the money covered calls, and you can put in your cost basis if you want and hit income generation, and it'll pick one that's usually relatively far out. But yeah, that's how that works. And yeah, obviously yes, Ron, the stock does have a higher risk of being called away at that point. But that's fine. We're trying to make money off of selling option premium in this strategy. And so we're going to sell the highest option premium we can get, which is at the money. All right, are there more questions? I will be putting, as usual, a copy of the slides and the recording of this presentation on the website tomorrow, and we'll be sending out a link to everybody also. And then our next workshop will be on, it looks like, the 27th. So hopefully we'll actually have an answer on Brexit and not a shruggy at that point, because the deadline is, I think, the 29th. So yeah, if we still have a shruggy on Brexit at that point, it might be a pretty ugly day in the market 2 days ahead of that. But we'll see. All right, well, this is a pretty low on questions group today. I got a few more minutes that I can hang out and wait for questions, but then we'll wrap things up and I'll let you get back to your day. All right, it doesn't seem like there are any more questions, so I'm going to go ahead and sign off. Thank you all for coming. I hope to talk to you again on the 27th. If you have questions between now and then, you can hit this help button on the website and send us an email or give us a call, and we'll be happy to help you out. Thank you, and enjoy the rest of your Wednesday.